$35 trillion. Okay, let's just let that sink in for a second. Today we're diving straight into a highly urgent explainer covering the Global Macro Insights Report dated June 15th, 2026. And we're unpacking a strategic analysis that deals with some incredibly heavy but honestly absolutely vital economic realities. You know, this isn't just about abstract numbers on a page. It's about a fundamental shift in global financial sovereignty and a fiscal crisis that the document argues isn't just coming, it's actually already here. So get comfortable, because we're going to map out exactly what this report says about the current state of the world's largest economy, and more importantly, where the whole global financial system is heading next.
So think about the sheer scale of that number. 35 trillion in public debt is absolutely no longer just some future warning, it's a mathematical reality today. The report paints a really vivid picture right out of the gate. I mean, imagine the national debt clock in Manhattan, right? The numbers are spinning so fast, they literally become an absolute blur. We've officially surged past the $35 trillion mark, and the source material emphasizes that we are way past the point of treating this as a problem for tomorrow. What we're witnessing right now is the collision of decades of deficit spending crashing headfirst into a brand new era of structurally higher interest rates.
Section 1. The 2026 Debt Trap, a mathematical reality.
The core question posed right at the beginning of the report is pretty staggering when you really think about it. Can the world's largest economy actually survive a scenario where it has to borrow money just to pay the interest on what it already owes? The authors make it extremely clear that the US dollar's historic, exorbitant privilege is facing its absolute greatest test since the 1970s. Because of this whole dynamic, the window for a traditional, painless soft landing is rapidly closing. The math is just getting too heavy to ignore.
But here is where the twist comes in. The dollar's dominance has actually triggered what the report calls a boomerang effect. For decades, Washington has used the dollar to project power and enforce sanctions, right? But by aggressively issuing treasuries and weaponizing the financial system, they've inadvertently incentivized the rest of the world to start building parallel financial architectures. They've saturated the market. And as the supply of this debt just keeps increasing, global creditors are naturally starting to question the so-called risk-free nature of US treasuries. It's a fascinating irony highlighted by the authors. The very tool used to maintain global order is now being analyzed as a primary source of domestic instability.
Moving on to Section 2, the interest rate spiral, or what they call the 2026 death cross. We have reached a deeply sobering milestone. The cost of paying for the past, meaning the interest on the national debt, now officially exceeds the entire US defense budget. Reached in the 2026 fiscal year, the report emphasizes that this represents a fundamental, massive shift. I mean, when a nation's interest payments eclipse its defense spending, you're looking at a system where managing the baggage of yesterday is actively consuming the resources needed for today.
And because interest rates have remained elevated to fight off persistent inflation, this interest rate spiral becomes completely self-sustaining. The result? Well, it drains capital straight away from the private sector. Every single new dollar borrowed to cover the deficit comes at a significantly higher cost. Ultimately, this creates a massive crowding out effect, which in turn stifles long-term economic growth. You simply can't tax your way out of a curve that is growing exponentially faster than your underlying economy. It just doesn't work.
All right, Section 3, Global De-dollarization and BRICS. So de-dollarization is absolutely no longer theoretical in 2026. It's a heavily documented systematic trend. The BRICS Plus alliance has officially matured into a highly formidable economic bloc. Major holders of US debt, notably China and Japan, have actually reduced their treasury positions down to multi-decade lows. Instead of buying more US debt, these nations are insulating themselves from sanctions risk and fiscal volatility by opting for regional currency swaps and hard assets. We're also seeing a massive surge in commodity-backed trade, stuff like oil, gas, and minerals being priced in non-dollar currencies, which actively weakens the traditional petrodollar foundation that supported US hegemony for half a century. Now, this global demand for alternatives to fiat paper is a direct, immediate response to the domestic debt trap we were just talking about. Global players aren't just sitting around, they're actively looking for a lifeboat. The rise of this new multipolar financial order isn't happening in a vacuum. It's a direct, calculated recalculation of risk by the entire international community.
Which brings us to Section 4, the digital dollar debate.
As this debt crisis intensifies, central banks are rapidly accelerating their transition to a digital dollar, or a CBDC. Proponents of CBDCs champion this new technology as absolutely necessary, for its efficiency in managing the massive debt and for allowing highly programmable monetary policy. However, the source document deeply analyzes the accompanying risks to personal privacy and freedom that inherently come with rolling out such a centralized digital system.
So the big debate here is this: is programmable money actually a solution, or is it a mechanism for financial surveillance? The report heavily outlines the fear of what they term financial repression. The major concern here is that a fully digital currency could theoretically be used to enforce negative interest rates, or frankly, restrict capital flight, which would effectively trap citizens' capital within a failing fiscal system. It poses a really critical question about the future of individual liberty in a fully digitized financial world.
It all really comes down to a massive global tug of war. On one side, you have systemic, digitized control being pushed by central banks, and on the other, you have the individual, physical autonomy of hard assets. It's a fundamental clash between top-down management of the crisis through a brand new technological grid and the bottom-up flight to what the report has dubbed the gold lifeboat.
And that transitions us perfectly into Section 5, Achieving Financial Sovereignty. In this incredibly debt-saturated world, the surge to unprecedented highs for physical gold is framed strictly by the report as a return to sound money principles. They insist this isn't just being driven by day traders or market speculation, it's a fundamental flight to safety. I mean, even central banks globally are hitting absolute record levels of accumulation, signaling that they themselves are preparing for a post-dollar reality. Why? Because as the document explains, physical gold remains the only financial asset that isn't simultaneously someone else's liability. It's the ultimate historical hedge against the debasement of paper currency.
All this data points to one very clear directive from the report. The era of just passively relying on traditional financial institutions, yeah, that's over. The macroeconomic situation is undeniably challenging right now, but the focus of the report deliberately shifts here from macroeconomic fear over to proactive individual preparation.
The report outlines some extremely proactive steps you can take to build resilience. First, diversify your wealth into hard assets, like that gold lifeboat we discussed, assets that sit completely outside the paper liability system. Second, truly take the time to understand the mechanics of the debt trap so you aren't caught off guard by sudden inflation or that interest rate spiral we talked about. And third, stay proactively informed on geopolitical shifts, especially things like the BRICS de-dollarization trend. The math behind the $35 trillion debt trap is pretty crystal clear, and the window for a soft landing is officially closing. As the old system fractures, the document notes that the future belongs to those who prepare today. Understanding the mechanics is your first step. Preparing for the reality of what comes next is the absolutely crucial second step. So I'll leave you with this final thought. In this rapidly changing new era of individual sovereignty, what exactly is your next move?